Right, hey, welcome back, y'all. It's Principals Counting One. We're still here. We're rocking and rolling. We are all the way, believe it or not, all the way in week six already. So what does that mean? We're almost halfway done with our class. Believe it or not, in week eight we'll be halfway. Yeah, so it goes by really, really quickly. And so just want to say thank you for all of your efforts so far and for everything that you're doing. Super important to me and obviously super important to yourselves that we keep on rolling. So please, let's continue to make excellent progress by submitting our work on time and getting ready for that midterm, which is coming up in, believe it or not, it's already in 2 weeks. So yeah, it goes by really fast. Let's go ahead and jump into our conversation today on retail, which is a really exciting topic. Um, we're going to talk about, we talked about last week about retail operations when we were in person. We're kind of carrying that same conversation, but we're going to jump into our inventory and we're going to talk about the cost of that inventory and how we value it. So, a couple of complex pieces here, but just like as we talked about before, if you think about like how things physically work in the store, it's going to make a lot of sense to you. So let's go ahead and jump into our discussion today on inventory. And we're also going to talk about those cost of goods sold, also known as cost of sales. And from that perspective, I'm going to show you a couple of different calculations on how we value the inventory, which is really the bulk of today's discussion. I'm gonna really focus our attention today on the things I feel are the most important for you to know, and then we'll kind of breeze through some of the other stuff. And of course, I'll kind of give you some great experience discussions from good old Macy's and our experiences there. And we'll also talk about some other retail experiences that we may have had. So, uh, last week we talked very briefly about uh, our accounts payables and receivables, and when we offer credit terms. And in class last week, we talked about credit terms at length. And it's important that we know those credit terms because we need to understand who's responsible for the paying for the shipping of the inventory, who's responsible for the inventory while it's in transit. So we need to really understand that because we need to know whether we need to add the cost of the shipping to our inventory costs or are they just simply expenses? And that's really the biggest difference, and that's really the important thing when it comes to goods in transit. We also need to talk about this concept called consignment. I guess I have a question for y'all. Have you ever been to a consignment shop? Do you know what a consignment shop is? Any takers, any consignment shoppers out there? Makeda?
Yes.
Makeda? Yeah? Okay, so tell me,
Yes.
Makeda, about your experience.
Consignment is like, okay, like for example, liquor, like a liquor store, like when you take liquor on, I don't want to use the same word, but when you like, it's not a loan, but you take liquor from them and then you pay for it. But how they do it, it's like weird with like the money part, because they
Yeah.
take like 50 Hennessy or whatever, and they come to agreement to like one amount of money or something.
Yeah, yeah, no, that's a good example. It's pretty rare actually that example you gave, but it is a good example. Um, so consignment, the way it works is let's say you go to a consignment shop that sells used clothing, okay? Very, very typical type of outlet consignment shop. When you go in there, you're going to notice that the tags will have like a little number on it or some type of designation to identify who actually owns that inventory. Now, the way it works is that someone like you or myself can bring our stuff that we want to sell to a consignment shop, and the consignment shop will sell our stuff on our behalf. All right. They'll receive the cash from the customer, and then they'll pay us for what we sold, and then they'll keep a small portion for themselves, like a fee. Okay. Well, that's the way that it works. That's what consignment is the retailer, which is the consignment shop, they actually don't have the inventory. They don't own the inventory. The individuals do. And that retail shop is selling it on the individual's behalf. And so the consignment shop actually never records inventory on their books. Now, Macadia, the example that you gave with the liquor shop example, it works in a similar way. So the way that that works is that the vendors of the liquor provide the liquor shop with the inventory, and the shop sells it on their behalf. And then after the sale is made, that's when the distributor gets paid.
Okay.
So, but it's a pretty similar example. Not quite the same, but it's pretty close. Yeah.
Back home in Jamaica, they normally do consignment. Like if they're keeping a party, so they would go to like Ray and Nephew or and take liquor on consignment. But what
Yeah.
I forgot to add was like if all the liquor is not if you like you keep a party and you don't sell off all the liquor or whatever, you can take that liquor back.
Correct. Yeah. Yeah. And consignment shops work the same exact way. So let's say we bring in our used clothing to the store and they don't sell it, we can always take it back. Yeah. Exactly. Yeah. That's exactly the way that they work. Very well done. So that's consignment. We'll talk about that again briefly. And then the last part here that we need to know about, which is a little bit more rare, are damaged goods or obsolete goods. We talked briefly about this last week. But if, let's say, we receive a shipment and some of that inventory is damaged, we might call up the vendor and say, hey, we're going to send you back the damaged goods. So that's a return. Or the vendor might say, "Hey, you know what? Just keep that. And we'll reduce it from your bill. That's an allowance." So we talked about returns and allowances last week. So yeah, these things will come back up again, but very briefly. So let's talk a little bit more in detail about those goods in transit, or who's responsible for the shipping is what this boils down to. Now, there's two terms for transit, and that's free on board shipping point, and the other is free on board destination. Now, free on board shipping point, what that means is that the buyer's responsible for that inventory from the point of where it shipped from. So that means that whoever bought that inventory, they are responsible for adding that cost of the shipping to their inventory total cost. So let's say we have our corner store and we purchased inventory from our vendor. They shipped it to us, free on board shipping point. What that means is that we have to pay for the shipping as the customer, and we are going to add that total shipping cost to our total inventory amount. So we'll debit inventory and we'll credit cash, or we'll credit shipping payable, or wages pay, or I'm sorry, accounts payable. So that's free on board shipping point. Free on board destination means that the seller is responsible for the inventory while it's in transit, and ultimately the seller is paying for the shipping. That's free on board destination. So, free on board destination, the seller is responsible for the shipping cost. And so, what the seller does is they simply pay for that expense. Oftentimes, it's included in the total price to the customer, but for the most part, the seller just expenses it out. So the seller in this case will debit, shipping expense, and then credit cash. Yeah, pretty straightforward. Consignment. Consignment shop is kind of like a middleman, right? That's what a consignment shop is. So there's the consignor, that's the person that owns the inventory. So that would be you or me when we bring our stuff to the consignment shop. We maintain ownership of that inventory. The consignment shop never records inventory. Okay. So, in other words, we're responsible for that inventory while it's at that third party, while it's at that shop before it's sold. So we are the consignor. We're selling our stuff, but we're doing it through consignment, meaning we're going to sell it through a shop that's not owned by us. Um, we have a consignee. Consignee is the person selling the goods on behalf of the person who owns the goods. A consignee is the consignment shop. Inventory is only recorded on the consignor. That's the person who owns and is in legal possession of the goods. The consignee never reports inventory. They're just a middle person. Okay, they're a pass-through entity. The way that a consignment shop gets paid is when they sell the consignor's inventory. The consignee typically receives a small fee, and the rest of it is given back to the consignor. That's the way consignment shops work. And then we have damaged or obsolete goods. If the goods are damaged and they can be resold, I mean they can be sold after the fact. They're typically sold at a bit of a loss. Okay. I'm going to give you an example of that. Let's say, well, let me ask you, have you ever heard of a scratch and dent store? Do you know what that is? Have you ever heard of that? Scratch and dent? That's actually the technical name of this type of place. Kira.
Um, yes, I haven't heard of an actual scratch and dent store. Well, I haven't seen it, but I know that a while ago, large appliances such as wash machines and dryers were reduced at a price because they had
Yeah,
some scratches or dents. Maybe they got a little banged up in transit
exactly.
and the purchaser just didn't want it because the look wasn't appealing,
Right.
but nothing was wrong with it. So instead of
Exactly.
the company just taking it as a complete loss, they just popped it in, I guess would be a scratch and dent store and just marked it down.
You got it. That's exactly it. That's exactly what a scratch and dent store is. They don't call, I mean, the technical name is not scratch and dent. It's not what you're going to see on the storefront. It's usually like appliance outlet or, discount appliance or, something along those lines. It's a scratch and dent store. And as Kiara accurately mentioned, it's this place where the original customer didn't accept it because it was, damaged. And so it's not defective, it still works. It's just, not that pretty looking. And so they'll send it off to some warehouse or whatever and they'll sell it as it is and it's usually at a very heavy discount. Yeah, it's that's so if they can so in other words, if the damaged or obsolete goods can be sold, they're included in our inventory, but at a what we call the net realizable value. That's the sales price minus its cost. And sometimes this might be at a loss. It depends, but for the most part, we can still sell it. It's just heavily discounted. There's also times where the damaged or obsolete goods cannot be resold, and in which case they're either returned or either a return or allowance made with the original seller, the vendor. So that's damaged or obsolete goods. Oh, I should also mention the word obsolete simply means that it's super old and that was replaced with a newer model. So example of that would be the iPhone. I don't even know what number you all are up to these days. iPhone 2026. I don't know. I don't know numbers. So let's say 2026 version of the iPhone comes out. The 2025 version of the iPhone is now considered what we call obsolete. It's being replaced with the 2026 version. That's what obsolete means. It just means it's old. You can still sell it even if it's the older model. We typically do sell older models. It's just at a significantly reduced cost or reduced price. So how do we know how much our inventory actually costs? That's a great question. I get that kind of question all the time from my clients when I do consulting work with retailers. And a lot of times they think it's just whatever it is that they paid for it, which is not necessarily true. It actually involves a little bit more than that. So for my retail friends in the classroom, you know what it's like in retail. You know how hard it is to work in retail sometimes. And getting the stuff out in the shelves is not always as straightforward as it sounds. We receive the inventory from the shipping department, if you will, or the from the warehouse that gets shipped to the store, and we have to offload it, and then we have to get it ready for sale. Right? We got to take it out of the bags and make sure the tags are on everything, and wheel it on out to the sales floor. Okay, yeah, or put it on the shelves. Right? That's a lot. Okay, and there's costs that go into all of that. It's not just the cost of the inventory that we paid for it when we purchased it from the vendor. It also includes, that we it is that, but we subtract out any discounts or returns we made to the vendor, and then we have to add in those other costs. The other costs include things like the shipping, getting the inventory to the store, storage. If I have to store it in a warehouse or in the stock room, that costs something, right? Insurance. When I am shipping or transporting inventory, I usually pay insurance on that. Especially if we're talking thousands, if not hundreds of thousands of dollars. And then, unfortunately, sometimes I have to pay import tax, yeah, also known as tariffs. And so all of these costs, well, I add them all together, plus the cost of the actual product that I paid for, minus any discounts and allowances, and that's my total cost of the actual inventory. So again, it's not just the purchase price of the inventory, it also includes all these other things: shipping, storage, insurance, and any taxes we have to pay on it. Then minus your discounts and returns. That gives you your total cost of inventory. Now, yesterday, I touched basis. Yesterday, sorry, last week, we touched basis on this. I gave the example. I want to say it was Sears, might have been Macy's. I don't remember. Um, these retailers, they take inventory. Yeah, we use the perpetual inventory system where we scan the barcode and it updates my total amount of inventory I have on the shelf. Yeah, of course. That's commonplace in retail. We call that the perpetual inventory system. You know that. We talked about that last week. You scan the barcode, updates the inventory totals. When I purchase more inventory from the vendors, I add that to my system. That way I have a running total of exactly how much inventory I have on hand, which is great in retail. You always should know how much exact inventory you have. But you also need to audit that inventory. You have to make sure that what is says the amount that you have in your system matches what you actually have on the shelves. And so sometimes you might go to a retail store like Macy's, for example, and you're going to see all these people counting the stuff on the shelves and putting tags on there. And this is usually done at the end of the night, randomly at least once a year, sometimes twice a year, depending on the size of the store. And what they're doing is they're validating what is actually on the shelf and they're comparing that to what is in their system. And if there's a difference, they have to make an adjusting entry to record that difference. So let's say there's some what we call shrinkage, which is the loss of inventory. And inventory can be lost through theft, through damage, through display models, through, it got broken, customer came and knocked the shelf over. I've done that before. That's not fun. Um, so we have to account for those types of things happening throughout the year. And so usually once or twice a year, we'll go through, we'll tag everything, and then we'll record a transaction, adjusting entry. So we'll debit cost of goods sold to increase the cost of goods sold. Even though we didn't sell it, we still have to recognize the cost of it. And then we're going to credit the inventory because we no longer have that inventory. And those are the adjusting entries I make when I lose inventory. Yeah. So it's important that we do have a strict control over our inventory on our sales floor. Every item should have a tag on it. It should have, a barcode. The counters should be of the inventory. They typically don't have responsibility over the inventory, so we don't want the same person doing similar work. Yeah. The people doing the inventory counting should also uh, confirm the that yeah, the inventory is on the shelf, what the amount is, what the quantity is, and what's the condition of the inventory. Is it damaged? Is it okay to sell? They should also there should also be a second count taking place. Someone coming through and validating, making sure that the original count is accurate. And then the manager goes through and confirms everything's only been counted once. And then at that point, they make those adjusting entries to ensure that what's on the shelf matches what is in the accounting record or in the point of sales. Okay, now for the fun stuff. I think fun. I need to talk to you today about the cost of inventory. Now, you already know what the cost of inventory is. It's the purchase price minus any discounts and allowances or returns and allowances. And then we add in the insurance, shipping, all that jazz, right? That's the total cost of the inventory. But we need to understand how to value that inventory. And there's actually a couple of different ways that companies do this. There's four primary methods to valuing the inventory or assigning cost to the inventory. And the first one we'll briefly talk about is called specific identification. This is usually for products that are unique. They are sold in very low volumes. They are of high value. They are relatively rare to speak of. We call that specific identification. Now, this is a very easy one to understand. And in fact, we don't really have too many diagrams on this one. Specific identification, here's how it works. Uh, an automotive dealership uses by specific identification to track their inventory because they sell vehicles. Now, each vehicle on the lot has a different value to it. Okay. That value is determined typically by how long it's been sitting there, how many miles it has, the condition that it's in, etc. Okay. The year that it was made, that those types of things. They all influence the total cost of the vehicle. And the reason why dealerships use specific identification is because they don't sell a whole lot of these. They're very high value items, and we can track each one of them individually through the vehicle identification number, also known as the VIN number. The same can be said with like a fine jewelry store. Okay, let's say you go into Patagonia or into Swarovski or some real high-end jewelry store, Tiffany's, And you'll notice that they don't have a whole lot of inventory. They have very few pieces, very unique pieces, and each piece of jewelry uh, is very specific. Okay. Uh, and each piece of jewelry will typically have a very small serial number engraved somewhere on the jewelry. Same with like fancy watches like Rolex or some fancy watches. On the back of the watch, you'll find a serial number. Uh, so fine jewelry, watches, they all use specific identification to track their inventory. Why? Because they're unique, high value, low sales volume. Those types of inventories, they use specific identification. The next inventory I'm going to tell you about, the next way we track inventory is called first in, first out, also known as FIFO. First in, first out. Now, here's the way that it works. Uh, as I purchase my inventory to then sell to my customers, I typically sell the first amount that I received first. First in, first out. Okay, that's what that means. This is typically used by grocery stores. Now, the reason why grocery stores commonly use first in, first out for their inventory valuation model is because uh, their products are perishable, they expire. Okay, so I want to sell my first inventory that I just got in. I want to sell that first because, yeah, it expires if I don't, right? So first in, first out. Used typically by grocery stores or any other company that sells perishable products. The next and most common method used is called last in, first out. So whatever my last purchase was, I'm going to sell that first. Last in, first out. Whatever my most recent purchase was, I'm going to sell that first. Last in, first out. Okay. Very commonly used among most retailers, including Amazon, including Walmart, or which are the two largest retailers in America. Uh, and a lot of other retailers also use last in, first out. Reason being is because it provides the highest cost of goods sold and the lowest inventory balance. Now, you might wonder why would a company want to do that? Because, it ends up reporting lower gross profit and lower inventory balances. The reason being is for taxes. Okay, so the IRS requires companies to actually report their taxes in last in, first out for their inventory, which is kind of counterintuitive because it actually gives the lowest taxable amount in the end, which is interesting. We'll talk more about that in a second. And then the fourth and most other common method, which is the easiest one, is called weighted average. With the weighted average, we simply take all of our purchases that we've made and we divide by the number of purchases that we made. So total amount divided by number of purchases made gives us the average, the weighted average. This next slide here that I'm showing you now is an awesome graphical representation of how the most common ones, first in, first out, last in, first out, and weighted average works. I really like this example a lot because it helps us to really understand it. So some of you might like sneakers. I'm a huge fan of Air Jordans. I always have been since I was a kid. And so one of the things I learned about Air Jordans is that they're really expensive, right? And they're nice. They're really expensive. And so or Timberlands, those were also like super popular when I was growing up. And so think about those kinds of shoes for a second, and you'll know that they're expensive. When we sell them. So I want you to think about that when we compare these three different types of inventory uh, cost models side by side. So first, let's take a look at the first in, first out model. So first in, first out, what it means is that we're going to sell our oldest purchase first. First in, first out. We're going to sell our oldest purchase first. First in, oldest purchase. We're going to sell that first. First out. First in, first out. Let's take a look at this. Let's break this down. So here we have a shoe company that purchased three different pairs of Air Jordans, and the company's selling each pair of Air Jordans for $100. That's the sale price. Now, the company purchased three pairs of Air Jordans throughout the month of May. First purchase was made May 1, the second was made May 3, and the third was made May 6, from different vendors, we'll say. Okay. And the purchase on May 1st is the one that we're going to sell first. First in, first out. The oldest purchase is sold first. Okay, first in, first out. So what that does for us using first in, first out is we take our sales minus cost of goods sold. In this case, the cost of goods sold is $45. That's our oldest purchase. That's the one we made first. Yeah. It gives us a gross profit of $55. Um, so that's interesting, right? It's a high gross profit, looks good. You'd think it would be the best one. And then whatever's left over, that's our ending inventory. So we made two other purchases after we sold that. So May 3rd and May 6th, 65 plus your 70 gives you $135 ending inventory balance. Okay, so that's first in, first out. It's pretty logical. We're selling the oldest inventory first. Now let's compare that to last in, first out, which is the most commonly used method. So last in, first out implies that we're going to sell our most recent purchase of inventory. We're going to sell that first. Last in, most recent. First out, we're going to sell that first. Okay. And as I mentioned, this is commonly used by pretty much all retailers that do not sell perishable products. So here's how it works. As you know, we have those three purchases of the Air Jordans that we made, 45, 65, and 70 respectively, on May 1, 3rd, and 6th. We sold the pair for $100. The cost of goods sold in last and first out is $70. It's the last purchase that we made. Last in, first out. And so that gives me a gross profit of 30, which is kind of low, right? I mean, we're comparing the three models. And my remaining inventory or ending inventory balance is my 65 plus my 45. Right? Those are my next oldest items. Gives me an ending inventory balance of 110. Now you might think to yourself, Dr. B, why the heck would any retailer want to use that? Because it gives them the lowest gross profit, right? As a manager, that's what you should be thinking. Gives you the lowest gross profit. Well, I'll tell you, the real reason why retailers do that is because companies are taxed, they pay income taxes based off of their operating income on the income statement. And clearly, a gross profit of 30 is going to give you the lowest operating income. So that reduces their total taxable amount. That's why most companies use last in, first out. Now let's compare first in, first out, last in, first out to weighted average. Weighted average is probably the easiest one to compute because we're just simply taking all of our purchases that we made on May 1, 3, and 6, 45 plus 65 plus 70 gives us 180. We're going to divide that by the number of purchases, which is 3 in this example. That gives me an weighted average cost of $60 a piece. Now remember, I sold one pair of Air Jordans, sold for $100. The cost of goods sold in this example is 60. The average, weighted average, is $60 each. So 100 minus 60 gives me a gross profit of 40 and an ending inventory of 120, 60 times 2. So that is uh, the comparisons. Weighted average always falls somewhere in between first and first out and last and first out. That's where the name comes from. It's the average. Last and first out will always give you the lowest gross profit and the lowest ending inventory. Last in, first out will always give you the lowest gross profit and the lowest ending inventory. First in, first out will always give you the highest possible gross profit and the highest possible ending inventory balance. And the reason why most companies and the IRS requires us to report in last in, first out is because it gives us the lowest taxable amount and the lowest carrying cost of inventory. Now, those are the three primary models. This should look familiar. I think we talked about this last week in person, how we calculate the merchandise available for sale. We take the beginning inventory plus our purchases, gives us this inventory available for sale. We can also take our ending inventory plus our cost of goods sold. That'll also give us merchandise available for sale. This is kind of a silly flow chart, I think. All right. Let's talk about that perpetual inventory system, and we're going to go into greater detail into specific identification, first and first out, last and first out, and weighted average. As you know, a perpetual inventory system updates our balances of inventory as we sell through them and as we make our purchases. It automatically updates our totals. We use the barcode when we sell. We use the barcode when we're receiving the inventory from our vendors. We add it into our system. Uh, it's the best method to use. It tracks all of our costs and updates everything for us. That's why the perpetual inventory system is the absolute best. Depending on the system, depending on the inventory cost method that we use, weighted average, first and first out, last and first out, or specific identification, each of those will have an effect on our ending inventory balance and our cost of goods sold total, just like we saw in our first example using the Air Jordans. So let's take a look at all four methods once more, but let's use a retailer that sells mountain bikes as an example. So here we have this retailer. They sell mountain bikes. They purchase their mountain bikes from various vendors and then they sell them. Makes sense. That's what a mountain bike shop does, or a bicycle shop does. They purchase their inventory from the various vendors and then they sell them to the public. Okay, so here we have a month worth of data from the bike shop. This is the month of August. And so for the month of August, we could see a couple of things happen in this company. They started the month of August with 10 bikes that they purchased from their vendor at $91 a piece, giving them a total cost of $910. That's what they started the month with. They then purchased from a different vendor 15 more bikes at $106 a piece for a total of $1,590. They added that to their existing inventory, giving them an updated balance of 25 bikes. On August 14th, they sold 20 bikes out of their existing inventory, and they sold that at $130 a piece, which meant that they only had 5 bikes left in their inventory. So a few days later, they called up their vendors, made some purchases. So on August 17th, They purchased 20 additional bikes at a cost of $115 a piece for $2,300, giving them 25 bikes available for sale. Then they purchased another 10 bikes from a different vendor for $119 a piece, which is $1,190, giving them 35 bikes total available for sale. Then on August 30th, they sold 23 bicycles for a total of $150 a piece. That was the sale price. Not bad, right? Uh, so they ended the month of August with 12 bikes on hand available for sale to sell in the month of September. So throughout the month, they had purchased 55 bikes for a total of 5,990. They sold 43 bikes, uh, and they ended the month with 12 left. So that's our data. We want to try to remember this data because I'm going to show you how we can apply this data using all four methods: specific identification, which is the serial numbers, uh, first in, first out, which means I'm going to sell my oldest inventory first. Last in, first out, I'm going to sell my most recent purchases first. And then I'll show you the weighted average. Weighted average moves along, gets updated as we move along. So I'll show you all four methods using the same data. First is specific identification. Very simple method. All we're doing here is we're going to total up all of our goods available for sale and all of our costs of goods sold, uh, and then give us our ending inventory. Remember, specific identifications based off of unique items that we're selling. In this example, we're saying that each bike has a document or a serial number associated with it, and therefore each bike we're going to track individually. So, so that's really what this shows us. That's specific identification. It's the easiest method, and we don't really talk too much about it because uh, most businesses don't use this. So it's again, this is really for like car dealerships or fine jewelry, expensive watches, that type of stuff. Anything with a serial number or a VIN number. First in, first out. Let's talk about that one, and we're going to apply that same concept. So with first in, first out, what that means is I'm going to sell my oldest inventory first. First in, my oldest purchases. First out, I'm going to sell those first. So what this means is that your oldest purchases that you made, or I'm sorry, your oldest inventory that you have is going to be equal to your cost of goods sold. Okay. And whatever you have left at the end of the month is going to be your most recent purchases, and that it's going to represent your ending inventory. So let's apply the data from the bike shop. So we started the month again with 10 bikes. We bought those at $91 a piece. We made some additional purchases on August the 3rd, 15 bikes at 106. I add that to my existing inventory, update my totals. Remember, this is a perpetual inventory system, so it automatically updates with every purchase and sale that we make. August 14th rolls around. First in, first out method means that I'm going to sell my oldest inventory first. So the first thing I'm going to do, we sold, what was it, 20 bikes, right? We sold 20 bicycles on August 14th. The first batch I'm going to sell is going to be my oldest inventory. In this case, it was my beginning balance inventory. So 10 at 91. Then I'm going to sell 10 out of the other oldest inventory, which was the purchases we made on August 3rd. 10 at 106. I add those together to get $1,970 with the cost of goods sold on August 14th. I update my ending inventory, 5 bikes at 106. Okay. That's how first in, first out works. I'm selling my oldest inventory first. First in, first out. Then on August 17th, I purchased that additional 20 bikes at 115. Then another purchase August 28th, 10 at 119. And then on August 30th, I sold, I forgot how many bikes I sold. A lot, right? I sold 20, I sold 30 bikes, right? No, 23 bikes is what I sold on August 30th. So I'm going to sell my oldest remaining inventory first. And that was the five bikes at 106 from August 14th. I'm going to sell that first, yeah, because this is my oldest inventory. Then I'm going to sell 18 bikes out of my August 17th purchase. So 18 at 115 a piece. Give me a cost of goods sold for August 30th of 2,600 bucks. And then as you can see, my inventory balance reflects my remaining most recent purchases. Two at 115 and the 10 at 119. See how that works? That is the first in, first out method. Next, I'm going to tell you about the one that is most commonly used by retailers across America, and this is also for IRS reporting requirements, is the last in, first out method, which implies that your most recent purchases are going to be sold first. Last in, most recent purchases, we're going to sell those first. So last in, first out. Okay, so your most recent purchases from your vendors is going to be your cost of goods sold, and your oldest inventory that you have is going to be your ending inventory balance. So let's apply using the same exact data we have from before. As you know, we have our beginning balance 10 at 91. We made 15 bike purchases at 106 from a different vendor on August 13th. So we add that to our inventory. Then on August 14th, we made our sales. Now, take a look at this. This is where it gets different, right? August 14th, the first amount that I sold, 15 bikes at 106. That was my most recent purchase on that day. Okay. I'm going to sell that first. Then whatever's left, I'm going to sell out of the older inventory, five at 91. I add those together to get $2,045 cost of goods sold. I update my ending inventory to be five at $91, 455. Remember, with last in, first out, whatever I most recently purchased is what I'm going to sell first. My ending inventory is going to reflect my oldest inventory. Okay. Then on August 17th, I made those purchases, 20 bikes at 115. Then once again, August 28th, I purchased another 10 at 119. Then August 30th rolls around, I sold 23 bikes. I'm going to sell the most recent inventory purchases first. Last in, most recent purchases. First out, first to be sold. So I sold 23 bikes, 10 at 119. That was my most recent purchase that I made on the 28th. I sell that batch first. Okay. Then the remainder I'm going to sell from that next oldest purchase, which would have been from the 17th. I'm going to sell 13 bikes there at 115. I add those together to get $2,685 cost of goods sold for August 30th. And then as you can see with the ending inventory, it's my oldest inventory. That's what I got left. Five at 91 bucks. That was back from the beginning of the month. And then seven at 115. That's what I had left. Right. So uh that's last and first out. You can see your total cost of goods sold in last and first out was 4,730, and your ending inventory was 1,260. And then lastly, let's compare that to our weighted average. Now, the thing you have to know about weighted average is that the average updates based off of what is bought and sold. weighted average. This is also known as a moving average, or average cost. So the way that we calculate that is we take our cost of goods available for sale on the day of each sale that we make, and divide that by the number of units available for sale at that same date. That's why we call it a weighted average. It's also known as a moving average. All right, so let's start at the beginning of the month. Began the month with 10 at 91, made my purchases 15 at 106. Now, since I made those purchases, I need to update my average. I started with 10 at 91. I purchased 15 at 106. I add those together. I get 2,500. All right. That's 25 bikes. I need to figure out the average. The average I'm going to get is $100 per bike. How would we get that? 2,500 divided by 25 bikes. That's what I had in my inventory on August 3rd. All right. Then August 14th, I sold 20 bikes at $100 a bike. Why 100? Because that was the average at the time. Then I need to update my ending inventory. I got 5 at 100. The month goes on. August 17th, I purchased 25 bikes at 115 from a different vendor. I add that to my ending inventory. I already had 5 at 100. Now I'm adding 20 at 115 for a total of 2,800. I'm going to divide that by 25 bikes available for sale on that date. They'll give me an average cost per bike of $112. See how this works? We keep updating the average as we go along, as we purchase and sell inventory. August 28th, I purchased an additional 10 bikes at 119 for 1,190. I add that to the inventory. Now I'm up to 35 bikes. Okay, 3,990 total cost divided by 35 bikes. Give me an average cost per bike of 114. See where we're going, right? And then at the end of the month, we sold 23 bikes. The cost of goods sold in this is 114 per bike because that was the average cost at the time of the sale. Okay. And then whatever's left over is recorded as ending inventory. But that, my friends, is how the weighted average works. So our cost of goods sold August 30th was 2,622. Ending inventory at the end of the month was 1,368. Right? I don't know why this is here again. It just is. It just is. Okay. Uh this is it's just a summary. Just that's all it says. There is what you see at the bottom. It's just a summary. Okay, so that is weighted average. So also known as moving average. So looking at the three primary ones again, first in, first out, last in, first out, and weighted average. With the first in, first out, the ending inventory gives you the current cost, right? Because the uh, inventory that we are selling is our oldest inventory. We're going to sell that first. So first in, first out. Gives you inventory is its current ending inventory, it's its current cost. So whatever's most recent purchases, yeah. Last in, first out, your cost of goods sold gives you the idea of what your most recent purchases are or were. Okay. And your ending inventory is going to give you your oldest costs. And then with weighted average, we kind of just smooth everything out because it rolls along as we make purchases and sales. Now you know that the prices of inventory changes, especially since we're buying it from multiple vendors. So that's why it's important to really be able to calculate these different methods. I like this slide because it shows us a nice comparison between the four methods that we talked about. The biggest differences you're always going to see is going to be your cost of goods sold, which means you're going to have a different gross profit, but also your inventory balances. Now, taking a look, you might think to yourself, oh, I personally like first in, first out because it gives me the greatest gross profit. I like that too, especially when I'm trying to attract new investors. I'm going to show them a nice gross profit, you know? But I don't like it when it comes time to pay my taxes. When I pay my taxes, I like last in, first out. Why? Because I'm going to pay less on my taxable income because I have a lower gross profit. You see what I'm saying? So that's why, for reporting reasons, it's important to be able to calculate the different ones. You can use a different one throughout the year, but at the end of the year, when you file the company's taxes, you need to convert it to last in, first out because that's what the IRS recognizes. And the real reason you don't want to pay a whole lot in taxes. So last in, first out it is. Oh, sorry. I just realized this is here. Yeah, so IRS requires last in, first out to be used for reporting purposes. Uh, you don't have to use it throughout the entire year, as I said. Um, but at the end of the year, when you file your taxes, you want to switch everything over to last in, first out. I'll also say the other great news is because we have technology these days that do a lot of the stuff for us, it makes it a lot easier for us to track and to be able to convert between the different methods. Another thing we need to talk about related to inventory is uh, when inventory must be adjusted downward. Now, the reason why we adjust inventory costs downward is to reflect changes that have occurred in the market. I'll give you a classic example of this. Uh, the vehicle market. Okay, the vehicle market is notorious for having fluctuations in price. Okay, if I have, let's say I'm a car dealer, if I have a bunch of vehicles sitting on my lot and no one's buying cars, the sales price has got to come down. I can't sell it. Okay, I got to put it on sale. All right. So I need to adjust the value of that inventory downward to reflect that change in the marketplace. Okay. It has to happen. Otherwise, I'm not going to be able to sell it. We call this concept the lower of cost or market. Whichever is lowest is what gets recorded as the value of the inventory. Okay. Whether the market price is lowest, that's the amount that gets recorded. Or if the cost of the inventory is lower, that's what gets recorded. So it's lower of cost of the inventory, or the market value of the inventory. Whichever is lower is what gets recorded as the cost of your inventory. Call this concept the lower of cost or net realizable value. All right, here we have an example of this. We have a retailer that sells two different vehicles. They sell a Roadster and a Sprinter. These are both racing vehicles. Okay, they they go around the dirt racetrack. Yeah. So here's how it works. The company has the Roadster and the Sprinter. they have 20 Roadsters and 10 Sprinters available in their inventory. The cost of the Roadster is 8,500. The cost of the Sprinter is 5,000. The current market value of the Roadster went down to 7,000, and the Sprinter market value is at 6,000. According to the lower cost or market net realizable value, we record whichever is lowest for each inventory. Now, in this case, for the Roadster, the market value is the lowest, sitting at 140,000, which is the market value of 7,000 times 20. Okay. And then in the case of the Sprinter, the cost of the inventory is lower than the market value. So therefore, we're going to record the Sprinter's cost at 50,000. That is your 10 units times 5,000 apiece. And then we add the two together, we get 190,000, which is the lower cost of market value for all of the inventory available. Now, because we are writing down the value of inventory, we need to adjust our inventory account. We need to adjust it downward. The way that we do that is we're going to debit cost of goods sold to increase that cost of goods sold because the cost of selling our inventory went up and the value of the inventory went down. So in this case, we make the adjusting entry for 30,000. How do we get 30,000? We took the total cost of the inventory, we subtracted that from the lower cost of market, and that gives us 30,000 in this case. So that is the lower cost of market. A couple of steps in that computation. When we use first in, first out, weighted average, or specific identification, we adjust the inventory downward to the net realizable value. Net realizable value is the sale price minus its cost. We look at each individual item and we compare the market value to its cost, and then we adjust downward if the net realizable value is less than the cost of the inventory. That's the concept behind it. Now, of course, when there are changes in our inventory, there is an effect that happens on the financial statements, as you know. So let's say that we, at the end of the year, we counted our inventory. We realized that our ending inventory is actually higher than what we had reported. That means that our ending inventory is understated. That means that our cost of goods sold were higher in year one, and our net income was lower in year one. So we need to make an adjusting entry to reduce the cost of goods sold in that case and increase the net income. That adjusting entry comes in year two. Reason for that is because year one had already ended. And I can't go back in time if I don't have a time machine. And that's what this reflects. The opposite's also true. If we had undervalued our ending inventory, that means they were overstated. That means our cost of goods sold weren't high enough in year one, and our net income was higher than it was supposed to be in year one. So then we make the adjusting entry by debiting cost of goods sold and we're going to credit the ending inventory. I'm sorry, our inventory account. And so what that'll do is that'll adjust cost of goods sold up and reduce the net income in year two. And then in year three, everything should be fine, ideally. This just recaps the effect on the balance sheet. When ending inventory is understated, that means that we are understating our total assets and we're understating our total equity. Because remember, with equity, that's where your revenue and expenses show up. And then for if the ending inventory is overstated, that means we're also high on our assets and high on our equity. Now, well, through the adjusting entries, these get fixed. One of the other things I need to tell you about tonight, a couple of ratios. I know how much you love them. They're like your favorite. You're like, Dr. B, I love the ratio so much. I wish you could give me more of them. And I'm like, oh, don't worry, I will. And so here's a few of them. One of those is called the inventory turnover ratio. It tells me about the company's ability to sell through its inventory and how many times they can turn over that inventory, meaning they buy and sell it, how many times they can buy and sell it throughout the year. And so to calculate this, we take the cost of goods sold, divided at the end of the year, divided by the average inventory for the year. And remember, the way that we calculate average anything in accounting is we take the beginning balance plus the ending balance and we divide that by two. Because it's our inventory turnover, how many times I can sell it, that same inventory throughout the year. Another good one for managers to know is the days sales in inventory, how long it's sitting on your shelf. That's what this tells me. We take ending inventory, end of the year, divided by cost of goods sold, and we multiply that by 365 days. Tells me how long it's sitting on the shelf. Here we have a nice comparison between Costco and Walmart with respect to our inventory turnover and day sales in inventory. I can tell you that Costco sells through their inventory much faster than Walmart does and stays on their shelves a lot less. But it's also important to make the distinction between the two companies. Walmart's a much larger company than Costco is. They sell a lot more products than Costco does. So I don't know if this is a really fair comparison, my opinion. All right. And then lastly, I'm going to briefly talk to you about the way that we go through identifying the specific identification, first in, first out, last in, first out, and weighted average methods using the periodic inventory system, which is where we periodically update our balances. Uh, and this uh, is very similar to the perpetual system. The only difference is that we don't continuously update. We only update periodically. And so here we have same information from our earlier example. Using the periodic inventory system, we can update periodically. And so what that means is that I'm at the end of each month, I'm going to update my inventory records. So very simple. I just take all of my available for sales, add them all. I add up all my purchases. I add up all my cost of goods sold I made throughout the month, and then I add up my ending inventory. It's really, really easy to do. I do the same process for my first in, first out. My cost of goods sold, of course, are going to be my oldest inventory. I'm going to sell that first. So you can see that we're doing that in the cost of goods sold area. And then whatever is left at the end of the month is our ending inventory. Very, very easy, very simple to do using the periodic inventory system. Last in, first out, it's just the opposite. Our oldest inventory is going to be our ending inventory, which we can see there on the right. And then our cost of goods sold is going to be reflective of our most recent purchases. Last in, first out. And then with average cost, it's extremely easy to do. All we're doing is we're adding everything up and dividing. That's the periodic inventory system. Remember, periodic, we only update our balances at the end of the month. Perpetual, we update them as we go along. So that's those the primary differences. Uh, and then much lastly, I want to tell you about inventory estimation. Sometimes we don't always know exactly what our ending inventory is going to be, and so we can estimate that, and we can do that really using three steps for the retail method, or we can use the gross profit method. For the retail method, we take goods available for sale minus our total sales, gives us ending inventory at retail. Then we take our cost of goods available for sale divided by our cost available for sale at retail. That gives us our ratio, cost to retail ratio. I multiply that by our ending inventory at retail, giving me my estimated ending inventory at its cost. So again, sometimes we don't always know what the ending inventory is going to be, so we need to estimate. And this is one way of doing that. The other way of doing that is called the gross profit method, which is pretty easy. We take our total sales, we multiply that by 1 minus the gross profit ratio. It gives me my estimated cost of goods sold. And then step two, we take goods available for sale minus our estimated cost of goods sold, gives me the estimated ending inventory at cost. So, and that's really it. It's pretty straightforward stuff. Just a matter of following the steps. And my friends, we did pretty good. Wow, right on time. What's up with that? Amazing. Look at that. Incredible. With 30 seconds to spare. Okay. All right. So, just real quickly, going back to the classroom, as you know, we are already in week 6. We're almost halfway done with the semester. After week 7 and 8, we'll be halfway. So it goes by really, really fast. Yeah. So what you have to do for Sunday night, and I recommend that you do this on Thursday just to save yourself the headache and the time, is to complete the Chapter 6 quiz, which accompanies this week's discussion on our inventory and the cost of goods sold. Any questions, comments, or concerns that any of you have? Anything at all?
I,
Shannon?
I learned something about the consignment. I didn't know
Yeah.
that.
Oh, okay. I'm glad to teach you something new.
Yes.
Yeah, consignment shops are real interesting. The way to think about consignment shops is that they act as the middleman. So they actually don't carry the they obviously hold the inventory for the person that's selling them, but they don't actually count it in their books. And then when they sell it, they just take a small fee and the rest of it goes to whoever owned that inventory that they sold. Yeah, it's a really, really interesting concept.
Yeah.
Yeah. Awesome. Well, I'm glad. All right, my friends. So here's the deal. Next week on the 24th, so Tuesday the 24th is the next time that we're going to meet. We will be meeting in person on campus, live and in person on campus, February the 24th. That'll be the next time I'll see you. So, without ado, if you have any questions, comments, or concerns, you can email me, call me, set up office hours, whatever you need. You know, I'm here for you all the time. So, I hope you have an awesome rest of your night, a great week ahead, awesome weekend, and I look forward to seeing you in person on the 24th in class next Tuesday. Have a
Thank you.
great night, y'all. Thank you so much.
All
Appreciate
right,
it.
you
Thanks,
too.
Professor. Have a great night.
You too. Thank you so much. Take care.
Have a great night,
You,
Professor.
you too. Thank you so much. Good night. Good night.